Inflation-related market speculation has resulted in large sell-offs, and investors are scrambling to preserve their investments as stock prices collapse. Some of you may be wondering if there's a way to avoid inflation and perhaps even profit from it. Fortunately for you, Warren Buffett has experienced inflationary periods in the past and is an expert in making money from them. He has benefited significantly from inflationary periods in the economy and has advice that could be worth a lot to investors. Stay tuned, as in today's video, we discuss why Warren Buffett forecasts a terrible economic disaster where everything will fall and how to survive and benefit from inflation. Let's dive in. We are already at the pinnacle of the 21st century, where money isn't supposed to sit idle in your bank account. Warren Buffett has always advised multiplying your money throughout the day and letting it multiply while you sleep at night. This is the only way to compete equally with those who use their sweat and brains. The real question is why the 8th richest man in the world, with a net worth of $114 billion, made the audacious prediction that the market would crash in 2022. Every year in the beginning, when it's time for Warren Buffett's favorite stock market statistics and analysis, he gets down with his managers and forecasts how the market will behave in the coming year. However, this time he said something that didn't sit well with investors. He said that since the stock market has been at its peak for the past 28 to 30 years, we have unluckily entered a period of unprecedented stock market mania, during which we can only anticipate that 8 stocks will either return double or triple the amount we invested or completely crash. The stock market allows consumers to invest very little or a lot according to their investment needs in mint stocks of an existing company and then change their investment amounts in response to stock market conditions. If the market is doing well, your investments may increase by up to 5 times more than your initial deposit. As appealing as it may sound, everything that is wonderful comes at a high cost. It's excellent for you if you understand how the market rises and falls concerning global affairs. Still, you need to be sufficiently mentally invested in how the stock market operates to avoid paying a high price in the long run. Losses can be experienced instantly and in an amount equivalent to the profit. Although the risk percentage is relatively high, Warren contends that the current global diplomatic and financial crisis makes it statistically impossible for the markets to grow exponentially as they once did. Warren claims that despite the high risk, billionaires continue to invest in the stock market. The wealthiest people on earth are perhaps the largest players in this game. But you might ask, why should we believe anyone's opinion about the investment that nobody but us is going to make? Well, a significant reason for that could be the fact that such bigwigs in the stock market pool have experienced the market from a distance of even less than 1 centimeter. The market flashes before them because the multi-billion-dollar companies are the only ones responsible for how the market is expected to behave in the future. Even a 1% loss in any multi-billion-dollar company, or even Warren Buffett's own company, could cause millions of people to lose money because they could not predict the market rate. With enough justification to believe in this man, it's time to get down to business. It makes perfect sense for you to wonder how Warren Buffett makes such confident predictions. They take what is known as global market capitalization, which is nothing more than the aggregate value of all publicly traded corporations. The subsequent step is to divide the total market capitalization by the global GDP. The method is more complex than it first appears because it is time-consuming to factor in each company's global capitalization on the stock market before calculating the global GDP, which includes more than 1 million enterprises. The simple division of the total GDP by the market capitalization of the world should be less than 100%. Ideally, if it is less than 100%, it simply means that there is still an opportunity for an increase in share value and that the stock market will rise eventually for long-term investors. Although in these circumstances a rise should be anticipated, given the current state of the world's economy, a bit less than predicted would be discovered if we performed a standard calculation of the exact value. Experts speculate that the impact of COVID-19 may be to blame. As a result, many businesses had already suffered enormous losses, which had already caused the stock market to plummet. Although this might appear to be a bad thing from the perspective of sustainability, it is actually not that bad because as the market unexpectedly declined, the overall percentage of the value obtained after division decreased. However, if we look at specific countries as accountants, such as the USA, the GDP is currently very high. Consequently, the division's value is greater than 200%. Many governments of significant nations have drastically reduced the value of interest for the general public to prevent this. Although this may increase their losses, who cares about losses when you help sustainability, right? How do you intend to benefit from the current inflationary environment? Let us know in the comments below. If you like this video, please like and share. Also, subscribe to our channel for more such content. See you in the next video.